thank you everyone for joining in. We have a very interesting discussion today with Manish Gunwani on how one should approach investing across market cycles. I myself believe very strongly that market cycles is very important for all investors and keenly look out for that. So I'm very excited to have Manish with us today in our weekly spaces that we do every Wednesday evening. Uh, Manish, of course, has been the head of the equity fund management business with Bandhan AMC. He has been a veteran in the fund management space. He has experience of having worked with Nippon India Mutual Fund and ICICI Prudential AMC in his past experience, and he also um, has uh, been an exceptional fund manager and a very strong figure in the Indian mutual fund industry. So, Manish, very happy to have you here. Welcome to Cherry's Twitter Spaces.
Thanks, Shobit. Thanks a lot for having me, and it's a pleasure being here.
Okay, Manish, first things first. When people talk about market cycles, what do exactly they mean by market cycles? If you could just give our listeners a perspective of how you think about market cycles, and we take off from there.
Sure. So the way I would think about market cycle is in three tiers. And generally, I think the stock market or the stocks you should own have to fit in these three-tiered cycle to my mind. So the first is the global cycle. So global cycle typically are things like what is global GDP growth, what is credit growth, which regions are doing well, what is liquidity level. To me, at the global level, the single most important factor is the dollar trajectory. So I think a lot of capital markets globally are driven by how the dollar behaves. Typically, when dollar is appreciating, you will find that most markets will have tight liquidity. When dollar is depreciating, you will have good liquidity and market returns will be healthy. So that's at the global level. The second tier is at the country level. So obviously we are all investors in Indian market, so we should worry about India. But and generally, if you see at a country level, I think there are two important attributes when you are doing stock picking. One is what is the overall GDP growth. GDP number tends to be a bit opaque. So the good metric for growth, I think, is credit growth because that is a nominal real-time indicator you get. So if credit growth is typically doing well, then you will find that the economy is typically doing well and vice versa. The other thing at country level is a measure of imbalance. So the way I think about it is what for a human being is blood pressure and temperature, two important attributes to figure out if there's an imbalance. At a country level, it is inflation and current account deficit. So if the inflation is way above the target inflation, or if the current account deficit is very high, let's say 4-5% of GDP, it's like you have a problem. And the economy is overheated. It has fever in one sense. So you need to be careful about markets when these imbalances are there. But otherwise, you should worry about growth, which is tracked by GDP or credit growth or various other attributes we typically use like PMI, index of industrial production, etc. So that's the second tier at country level. Third, which is more related to stock picking, is that if a country is doing fine, typically by economic theory, there are four parts to a country's economy. which is consumption, government expenditure, private capex, and exports. So you have to figure out where is the country doing well. Like, is it household consumption driven? Is it private capex driven? So each of these components behave differently. Consumption tends to be more consistent. Um, the private capex tends to have long cycle of 8-10 years. Uh, Government spending driven sectors are very linked to policy. So you need to focus on where the government is driving the economy towards. And exports are actually linked to the global cycle. There also, I think you need to be clear: is Western hemisphere doing well? In which case, IT and some manufacturing may do well, or is it Asia, China, which is doing well? In which case, typically commodities do well. So I think these are the three tiers of cycle. If you are a stock market investor, I think it's very important to focus on these cycles. So, for example, the global cycle on the dollar side, as I said, the dollar is probably the most important variable. So, if you go back to 2002 to 2008, which was a long cycle, and the dollar fell a lot. If you go back to 2013 to 20, which was not great globally for capital markets, the dollar appreciated a lot. So these are long cycles. Obviously, you will get short cycles as well. So in that sense, I think it's good to think about markets from these three-tiered cycle framework.
So, in fact, Manish, that's a very, very good way of putting it, and I would say that the doctor has spoken. So, one must measure the temperature as well when we have the doctor in the house. So, how would you really put the current cycle in terms of all the three uh, ways in which you look at it? Where do we stand for each of those parameters?
Yeah, so if you were to think about last 18 months, for example, let's say 2022 and 23, I I think we are in short cycles right now. So if you think about 2022, um, at the global level, it was obviously very adverse because the dollar was appreciating, interest rates were high, GDP growth was coming down after the COVID bounce. And most importantly, as I said, since the dollar was appreciating globally, there was a lot of wealth destruction. So 2022 was one of those rare years where both bonds and equities globally lost a lot of money. India didn't actually face it too much because our market didn't do that badly, but it was a fairly traumatic year for global capital markets. So 2023, I think he's been different only because of, again, this in the dollar went up too much in 2022. There was a phase from Feb to maybe 1 month back when it corrected a lot. So if you follow the dollar index, which is a good measure of dollar strength, it had gone up to 114 in, let's say, 2022 from 99. And again, it went back to 99 in 2023 in that period between Feb, March to 1 month back or 2 months back. And in that phase, we saw the broader market in India do very well. Now, the dollar has again gone back to 107. And the initial rise, I think the Indian market weathered. But I think at this point, given where the dollar is, that it has already appreciated 6-7%. And it's appreciated because you are seeing issues in US 10-year yield going up to 4.6, 4.7, almost 100 odd pips hike in 3 months, which is very, very significant. So I would say that from a very tactical perspective, the global cycle is not looking good. The India cycle is actually looking pretty good because our inflation and current account are fairly okay. I am not saying they are great because with this recent rise in crude prices, there is implication for both inflation and current account. Uh, But on the growth side, if you see real-time data in terms of PMIs or credit growth, everything looks fine. On the inflation current account, there are no big red flags. It's not as good as 3 months back, but it's okay. So the India cycle is good. And within the India cycle, I think clearly we are seeing government-driven capex as one bright spot. Um, in general, consumption, again, if you divide into affluent versus mass, I think the affluent consumption continues to remain strong. Mass consumption has been weak last 2 years, but can revert to the mean. Goods exports and services exports, I think, is a weak spot. But within that, I think the China plus one sector should do okay. Um, and I think private capex looks to come back quite strongly, though there are global macro headwinds. But I think things like energy and power, there's been so much underinvestment, both domestic and global, that that can be a good sweet spot, I think.
Okay, so you are saying the US cycle seems to be losing steam, but the Indian uh, market cycle on both counts is holding forth. Uh, I am just tempted to ask, what is keeping the Indian cycle strong when generally we have always heard that when the global investors or the global market sneeze, India catches cold. What is happening differently this time that the India cycle is actually, uh, in a way, running out of turn than what the global cycle is?
Yeah, so see, not everything will be just top-down driven. There are obviously bottom-up things which happen, which can explain some deviations from this. But having said that, we have to be careful to say that India is decoupling. It's definitely not decoupling to my mind. That if you see since last 18 months, global economy has been slowing, and so has India after the COVID bounce. I think we are flat. We're probably in that 6 to 7% somewhere zone. If you see our long-term trend growth rate, we are not very different from that. We are not above trend for sure. So I think what's keeping India as an outlier on global growth is also, and a lot of these things, big cycles, big variables mean reward, right? So India had, I think, for example, two corporate profit to GDP cycles, which was 2002 to 2009. Corporate, or let's say Nifty profits grew 25% kinds, and then 2009 to 19, it was 70%. So the first phase, the corporate profits grew much above nominal GDP. The second phase, they grew reasonably below nominal GDP. And therefore, I think the mean reversion, which is probably playing out, whether it is banks earning or capital goods earning, is that this whole dry run in terms of corporate profits or capex over last 8, 10 years is now mean reverting. So again, just coming back to the example of power, I mean, India's power demand typically grows 4, 5%, but last 8, 10 years, there's hardly been any capacity addition. So now, obviously, there is merit in putting up a lot of capacity. So I think a lot of it is mean reversion. But the bottom up factors, for example, which are significant is um, the China plus one thing, right? I mean, geopolitically, we have been in a sweet spot where the world's manufacturing superpower is got into some issues where it's almost sure that they will lose market share. And it's up to various countries, whether it's India, Mexico, Vietnam, to pick up that market share. So that's a golden opportunity in one sense. Added to that is, as I said, policy is important. So the government definitely seems, and this is actually true globally as well. So even the US government is pushing up, manufacturing semiconductors and all that within the country. We are also, as a country, trying to push up manufacturing and various other things for security reasons or for not relying on China reasons. So I think those are the things which are creating this um, relative oasis to the world in terms of growth in India.
Okay, that's kind of some caution to the wind, and I think it's good to know that there are things that may not work out well for India, or rather, it has to maybe execute better than the opportunity at hand. So it can definitely look to take advantage, but it is not all simple and easy. Before I jump more onto India, and of course we'll discuss a lot more about India because that's where I think all the interest lies. But when you spoke about cycles, one thing that I picked up is anecdotally, all of us think cycles are like those typical sine curves we've
Yeah,
studied in our childhood days. But what you said is actually cycles are in a way warped. There can be times when things get compressed, a lot of things happen in short periods, and
yeah,
there are times when cycles get elongated. Now, one biggest example, which I think we are all seeing after a very, very long time, is the turnaround of US interest rates, and you spoke about them briefly.
yeah,
And we've been hearing points about how that can actually impact US GDP growth rate in itself. So, is there some while their currency has held strong and overall economy has still now held strong in the wake of COVID and overall issues that they were being created. Now, with this reversal in interest rates and all-time high interest rates in 15, 16 years, is there some structural change in their cycle that one should be worried about since they have such a big impact on global markets?
So yeah, these are very, very big questions. It's very difficult to forecast reality, but I'll take a shot at it. My sense is globally the debt levels and demographics are such that growth is not going to be very strong to my mind, because if you take big four areas of GDP, which is Europe, US, Japan, and China, I think US is relatively better, but there are obviously severe demographic issues in Japan, China, and Europe. Uh, the debt levels across these economies are relatively quite high. So, to that extent, it is difficult to believe that the 1990 to 2010 kind of global growth can repeat. Um, Now, the corollary to that is probably that um, ideally inflation should not be a long-term worry if growth is not great. And added to that are these big tech things about EVs and renewables, which should ideally mean that commodities like oil don't go up too much. So my medium-term outlook would be that uh, inflation and growth both would be quite mediocre. Having said that, the only thing that can probably keep interest rates up is the term premium, in the sense that uh, if you see the thing about this year also has been that globally growth has been relatively better than expectation, and one of the things that's driving it is relatively very strong government spending. So if you think about where fiscal deficits were pre-pandemic and where they are now, which is a normal year. See, the pandemic is obviously gone. So FY24 or CY23 is a normal year for most economies. So US pre-pandemic general fiscal deficit used to hover between 2 to 5%. It is actually 7%, 8% now. India, I think at one point we were wanting to go to 3.2, 3.5 at the central government level. We are at around 6. And a combined center plus state, we are still, I think, above 8 to 9, which is, again, for a normal year, these are pretty high numbers, which basically means your demand or your bond supply is going to be huge. And there might be a temporary phase where, we may see these blips where the bond yields shoot up because at this point, also what is happening, especially for US, is that uh, the foreigners who are big buyers of their bonds, China, Saudi, etc., they're not buying as much. Fed, which was a big buyer of the bond, obviously is in a reverse mode of QT rather than QE. Basically, they are selling bonds rather than buying. So there seems to be a bit of a demand supply issue rather than outlook on inflation. I don't think on a 2 3 year basis we need to worry too much about inflation because at least my view is that growth will be quite tepid. But yeah, I think we need to get through this phase and see how this demand supply of bonds get resolved in the near term.
Okay, so I'm taking it away as no alarm bells ringing, and this transition phase should hopefully not disturb us much. Uh, Coming back to India, Manish, so you spoke about the fact that how we are somewhere trying to hold ourselves up. Uh, what are the triggers, maybe two or three positive or two or three negative, that you think are going to play a key role in deciding which way the cycle moves, whether it can continue to uh, pedal higher, or are there going to be reasons which may bring it down? So, what are those factors that you think are critical for India's cycle to remain strong?
So I think of three, four things. One is a very famous one, which is unknown. Unknown is election. So I'll just classify it as a tail risk and keep that aside. Um, Two is surely, I mean, ultimately India is a alpha over global growth. So there is a certain alpha we have, which is typically about 3 to 4%. So if global growth is three, we will go at seven. Global growth is two, we'll probably go below six, something like that. So if at all we see US going into a sharp recession because these bond yields, let's say, push the housing market in US into stress, or a lot of the banks globally start making huge losses. I think we should remember that this is the third calendar year where globally bonds are losing money, which is unprecedented. I mean, apparently, never in history for 3 consecutive years bonds have lost money, and the cumulative losses are quite high. So, so we need to be mindful of the fact that such big losses somewhere can trigger which we had a kind of trailer with the Silicon Valley Bank and all that. So the second is any sharp downtick either in global growth or in a global credit event. Um, Obviously, the conditions are such that it is a risk. It's not normal in that sense. These kind of bonding are obviously not normal. Uh, the third is, I think, given what is happening to the bond yields, I guess there will be some retrenchment in government spending, um, which was anyway planned. So if you see, India has been planning that 6% central government deficit will go to 4.5 in 2 years. Now, that will mean that, let's say, if nominal GDP is 11 12%, the government expenditure will be less than that, maybe 6 7%. And that, I think, needs either global growth or private capex to come back because see, government spending is roughly 33% of our GDP, and if that big engine starts slowing down, uh, we need some other engine to start coming back, uh, and we need to see how this transition will happen. It could be consumption because mass consumption been weak, so it can mean revert. It could be private capex. It could be goods exports. So the three parts which have not been firing, they need to come back. But that transition, I think, is the key. And there's no way to predict, but I think you need to be mindful of what's happening because clearly government's role in driving the economy needs to come down, unless, of course, we see a supernormal jump in tax to GDP ratio, which at this point I don't think there is big evidence of. But yeah, maybe if that happens, then government can keep spending a lot, but that's not the base case I have. So yeah, I think when you're looking at growth, we need to just be focused on what will drive growth beyond FY24 because FY25 and 26, the government will not be there to drive growth. So I think these are two, three things that we need to be mindful about.
Hmm. And private capex typically goes through cycles as well of overcapacities and undercapacities. So, uh, how is that currently looking like in terms of capacity utilization? And do you think that there is a case of a reversal which is stronger than the other two factors? Because exports and consumption are, I think, going to be linked to a lot of other external variables also, or variables beyond control. But maybe
Yeah.
private capex, to my mind, looks like the lowest hanging between the three options of triggers that you spoke about. So, what's the situation there?
So I'm quite optimistic, especially on the energy transition theme, because I think, as I mentioned, the power demand supply today is skewed in favor of a lot of capex being done just to meet 4-5% demand growth in India. Otherwise, we'll have blackouts, which obviously none of us want. Uh, and also, it's coupled with a very rare synchronized capex happening in terms of moving away from fossil fuels to renewables, which also need a lot of investments in the grid because renewables tend to have very volatile output. Uh, why is this happening? It's not driven so much by demand supply as much as these imperatives of climate change and geopolitical issues around Ukraine, for example. But whatever said and done, I think at this point, a lot of it driven by government policy and government spending. There is a very synchronized capex cycle happening on renewables and transmission and distribution. So I think the sweet spot for me, and being mindful that it is policy driven. So if policy changes, I need to change my mind. I'm quite hopeful that this will be one of the growth engines. On the overall capex, if we start splitting it into three or four buckets, so one is power and energy, which I think will do fine. Two is commodity capex. Again, I'm not so positive that it will do gangbusters because whether it's oil exploration, refining, steel, aluminum, whatever, there's no global growth to need massive capex there. We may have the trend growth capex there, but I don't see a big cycle there. The third part of capex is household capex, which is a lot as real estate. Um, that seems to be doing well, although that has surprised me because interest rates going up typically has an effect on that cycle. But maybe again, it is that we had a long down cycle from 2013 to 2020, and that momentum seems to be absorbing this higher interest rates at this point of time. So there is a household capex which looks okay. And then there is general manufacturing capex, which I guess the parts which are China plus one should do pretty well. I'm not so sure about generic manufacturing capex because if global growth is slow, then, for example, autos. I think Indian consumption. not going to be super normal. So I'm not sure if auto capex, for example, will be great, or even cement capex. But but I think all these chemicals and anything where the PLI segments are playing out, where you can replace China, I think that capex should do fine. So overall, I do expect capex to be pretty interesting. But there are parts which I think will do well, parts which will not do well.
Interesting, actually. So one has to play it very carefully. There is no widespread
Yeah,
reversal or spend that you expect. Interesting. So, since we're talking specifics, apart from these at a fund level or as an investment strategy level, apart from power and renewables, maybe that you mentioned, are there any specific sectors out of the more popular track sectors like financials or autos or uh,
yeah.
some of the other sectors, which are the ones that you think are going to be a beneficiary of the current cycle?
So I think there are three or four themes or sectors which look interesting. So apart from this whole energy transition, power, renewable kind of stuff, um, so one is the mass consumption or rural consumption. I think it's been weak ever since COVID happened. Um, I think that that has a good chance to revive because, first of all, basically what has happened is the bottom 60-70% of household, for them to handle twin shocks of COVID and inflation was obviously tough because the balance sheets are more fragile. But again, a lot of the jobs have come back, the normal earnings have come back. So it's a matter of time as the balance sheet gets repaired, the consumption will start rising. And also, it's an election year where fair amount of spending, both formal, informal, happens at the ground level. So I think segments within that, like two-wheelers, FMCG, microfinance, wherever you think stocks are cheap, I think those are interesting spaces to look at. Um, the third part, I think, is the US generic pricing cycle for the pharma companies. Again, it's been since 2015, we've broadly been in a down cycle kind of environment. Uh, and I think we can take some small bets here because each company has issues on FDA, what molecule, etc. But I think being overweight can be quite good risk reward here. That's the third pocket. The fourth pocket is real estate. See, real estate on the demand side, it's already mid-cycle. So that part is not the excitement part, but I think what is exciting is the supply side that there is fair amount of consolidation that's happening. I think in some cities we are already seeing the branded or listed developers becoming more than 50% of new launches. And obviously that's a great sector in terms of size, right? I mean, it is a massive sector. So these are three, four sweet spots where we generally have reasonable amount of portfolio exposure.
Imagine who would have thought that real estate will go through such cycles of informal or unbranded going towards
Yeah,
branded, and in some
that's
manner,
true.
real estate has always been that one pillar of strength for investors, right? People think of real estate more as a perpetual upcycle kind of a sector, and we have seen one of the biggest cycles in real estate over the last 1 or 2 decades. So that's a very interesting uh, take from what you said. Uh, uh, in fact, Manish, I must share with you, we also come across two different kinds of investors. Typically, there are investors who are investing in cycles by looking at investing into funds which have delivered best returns. So I would say there are sets of investors who invest looking at cycles where things have done very well. And
Yeah,
then, of course, there are some investors who look at investing into funds or sectors where things have not been good, expecting a reversal. So, those are the two kind of investor insights I can share, where investors look at their investing biases either by investing into funds which have done very well or funds which have done very badly, expecting a reversal. So there is some parallel to investing through cycles. But having said that, having been in the market, how would you, uh, you know, look at your investing philosophy, and where do you think these kind of cycles can be made use of when investors are looking at making their investing decisions?
So I think it's important to ride the cycles. If you just go by recent memory, there have been houses or funds which have done very well from 2017 to 19, which was a Fed is at zero, price to earning multiples of stocks which are doing well are expanding. The set of stocks doing well is very narrow because globally growth is weak, dollar is strong. So that's the cycle 17 to 19. Then 20 to 23, we've seen uh, kind of mirror image where uh, the growth from obviously a bombed out base of COVID has been relatively okay. Um, the commodity prices have bounced back. Nominal growth across the world did well. So the value stocks, commodities or industrials and all came back, right? So the thing is, either there should be ideally funds which drives the cycle. So maybe if someone has a very long-term track record of 15, 20 years, you can be in a fund and hope that the fund manager drives those, is able to ride those cycles. Or if someone is a more active asset allocator, then you probably need to shuffle your asset allocation across funds or across the market cap curve, large cap, mid cap, small cap. Um, but yeah, I think it's important to ride these cycles. Otherwise, it can make a big difference to the returns, I guess.
So, in fact, Manish, at Cherry, we try to ensure, and we typically tell users that if you do follow asset classes, and some of these interactions with people like you are helpful in trying to understand which asset class is going in which direction in a broad way, then those investors, of course, can choose those asset classes on their own and have a mix of those asset classes basis their risk profile. But for many investors who do not understand which asset class is rightly priced, or which asset class is uh, maybe not the right asset class to go with right now, for those investors, there are always those kind of hybrid funds which are available. And I think mutual fund
Yeah.
industry per se has evolved beautifully in trying to now offer schemes across multiple different categories to suit different kind of investors. So maybe I'll just use this opportunity to urge all the listeners that they should decide which part of the compartment do they fall in, and if they do understand, then they should rightfully choose some of the schemes and funds managed by people like you, where they can actually focus on specific asset classes. And for people who don't think that they are able to call those things out, or difficult to track asset classes, it's always good to look at multi-asset or uh, multi allocation kind of schemes, and there are plenty of them also available on our platform. Uh, in fact, with that, Manish, I'll maybe ask one last question before we let you go. And I think since you're there, only fair to ask you your final take on the markets given the cycle, and from a valuation standpoint, from a direction standpoint, how do you think about that for the short term, and maybe slightly more medium term?
Yeah, so I think I have a bit of a contrarian view in the medium to long term that in spite of small caps doing well, I think medium to long term, I think that's the space that will relatively outperform in the market. So my view is predicated on the following that clearly, first of all, we have to assume that US is late cycle right now. Um, Either it's soft land or hard land, but difficult to see US accelerating from here. Um, China, Japan, Europe, I guess, are in that bucket of structural slowdown or average growth. Again, because of demographic, debt issues, whatever, it looks unlikely that they will again accelerate meaningfully in a long cycle. They may obviously uh, have phases where, because of low expectation, they surprise a bit, but it just looks too difficult for them to grow beyond 2-3%. Maybe China 4-5%, Japan and Europe at 2-3% max, right? So net over next 1 to 2 years, I guess we're looking first of all at a global GDP which is slowing. It can collapse also. There is a tail risk at such high interest rates, which is why it's late cycle, right? We don't know typically how cycles end, but the it late cycle definitely means that growth cannot accelerate from here, right?
Yeah.
So that's the global context we have. Um, so India has been holding on well, and there's no reason to believe, given this China plus one, given the fact that medium term, I do expect dollar to be weak because I think fundamentally it's a overvalued currency, has done well for last 10 years. If you see it on a real effective exchange rate, which is basically measured for inflation against a basket of currencies, it is very, very high. I mean, so I will take the bet that liquidity globally will be relatively quite okay in spite of growth not being great, which is my view that it's going to be, I think, a peculiar time because generally, if you see last 20 years, whenever global growth has slowed down, there's been a risk off and dollars done well. But I think India this time has two differences. One is I think maybe the dollar will be weak in spite of global growth slowing down, and two, domestic liquidity is obviously structurally improved with the penetration of mutual funds, AIF, PMS, etc. Um, so in that scenario, I don't expect a very broad-based earning growth or at least earning surprises happening. I think there'll be specific pockets which will do well, and a lot will depend how those themes are played. Um, so just to give you a broad context, I mean, I don't think IT services spending or overall bank credit growth will surprise us a lot on the upside. In which case, um, very, very large companies are unlikely to again surprise. Obviously, when they become very cheap, you buy them and you get a trade. But I think the real big money will be also since we are living in a world where technology is disrupting business models. So a lot of small companies which are either on the right side of the technology wave or they're on the right side of China plus one or the right side of a global wave like this renewables. Um, I think we need to be in those sweet spots. And therefore, because the small cap space give you the choice in terms of a lot more companies, a lot more new business models, I think the funds or houses which are able to uh, pick those sweet spots. I'm not necessarily saying the entire small cap index may do well, but I
Hmm.
think it's just going to be about how you get those sweet spots. I don't expect, as I said, a very because see, if global growth is slow, it definitely has an impact on India's growth. So I'm not even thinking India will go to 7.5-8%. India, I guess, will as long as US and China are slowing down, you have to assume that India can't grow massively at a GDP level. Um, so you need to roll up your sleeves, get those sweet spots. Whoever is able to do that, I think is the one who will create alpha. I know it's a
No,
cliche, but
no,
basically
no. I
what
think
I'm saying
no.
it's a stock
No.
pickers market.
Yeah, yeah. No, in fact, I was going to say that I think what I'm taking away is it is not going to be a easy highway to drive. So you better have
Yeah.
a good hand at picking the right stocks. And if you can't do it yourself, then of course people like Manish are there to help. So
Hopefully,
it's
yeah.
important to ride this kind of a jumpy terrain that one might expect. So yeah, stay in safe hands is a good idea. But I hear that, Manish, and I think with that, I think we are on time. I will have to wrap it up. Thank you so much, Manish, for taking time out. I think this was super helpful. We haven't done any session till now on market cycles, so it was great for you to have given us that perspective. I'm sure listeners would have found it very, very interesting to get that kind of a zoomed out view on how market cycles go. Thanks so much for taking the time out.
Thanks, Shubham. It's a pleasure being here.
Thank you. All right. Thanks. Bye bye.